This week on Islamic Markets Briefing, we will cover green sukuk issuance in Qatar, the halal industry's growth in Malaysia, Islamic banking development in Pakistan, and financial literacy in Indonesia. On Expert Talks, we'll be hearing from Ruggiero Lomonaco, fund manager at Rasmala, on Islamic real estate investment, market dynamics, and outlook. As Qatar is predicted to run a considerable budget surplus commencing in 2021, with export revenue exceeding its imports, the resultant excess returns will enable investments to be made through Qatar Financial Center institutions. The range of QFC financial institutions continues to grow through specialist funds, wealth managers, and reinsurance firms that are joining to provide services to and from Qatar. According to Thaddeus Malesa, Senior Advisor for Economics and Research at QFC, Qatar-based green bonds, sukuk, and ESG funds are set to be issued shortly. He added that aggressive green investments by Qatar Petroleum, together with guidance on ESG reporting by the Qatar Stock Exchange and QFC's institutional backing, would be the reasons for the launch of these products. COVID-19 has hampered Malaysia's ability to reach its target of having a domestic halal industry valued at $113.2 billion by 2030 from $68.4 billion in 2018 by dampening efforts for more industries to be competitive and work towards achieving this goal. The halal industry makes up about 15% of Malaysia's GDP, with the halal food and beverage sector accounting for over 85% of the country's halal exports, including the ingredients sector. In a special survey conducted online by the Department of Statistics in Malaysia, 53.4% of the surveyed businesses were able to survive only up to 2 months during the first movement control order imposed in 2020. Dr. Arif Alvi, President of Pakistan, has called for the establishment of Sharia-compliant instruments to promote spiritual satisfaction among people making use of loan facilities from the banks. President Alvi stressed the need to create awareness among women about loan facilities and stated that the banking sector should take measures to provide loans to women to encourage the setting up of small businesses. President Alvi also urged banks to develop links with universities to support research on the latest trends and demands of the market, and discussed the role of the government of Pakistan in promoting and encouraging Islamic banking in the country. Bank Muamalat Indonesia, BMI, and Indonesia Financial Services Authority, OJK, are collaborating to improve Islamic financial literacy in the country by using a multimedia and digital approach. According to Ahmed Kusna Permana, President Director of BMI, the collaboration aims to educate the public as well as boost the Sharia economy in Indonesia. Permana noted that the digital approach to improving financial literacy was most relevant and effective, and added that the responsibility for comprehensive financial understanding must involve all stakeholders in the industry. With Sharia principles centered around sustainable development and the real economy, Islamic finance has become an alternative model for the acquisition and development of assets in the real estate sector. Services provided by Islamic finance firms, ranging from residential mortgages to large-scale financing of acquisitions and construction projects, as well as the refinancing of facilities, have become popular. Within the real estate investment space, Islamic finance offers many benefits, like being able to adapt to different sizes and tenors of financing, local tax laws, and new techniques like Sharia-compliant real estate investment trust, REITs. A new trend has been observed with Islamic investors moving out of the United Kingdom and Europe into commercial and industrial real estate in Asia and Australia, providing the opportunity for Islamic finance to act as a substitute to traditional debt funding.
One of the main lessons that investors learned during that financial crisis is that excessive risk-taking in real estate investments didn't pay off. So when the last decade started, we certainly saw less risk in investments, so less use of leverage and less exposure to development and speculative type of strategies. As we were progressing in the decade, what we saw is a transition from traditional real estate asset classes towards more alternative asset classes. Traditional are typically the residential, the office, and to a certain extent, the retail markets. These have been the first recipient of the recovery, but as we were progressing, we started seeing new emerging sectors like student housing, the logistics, the data centers. So slowly the investors have migrated to the alternatives. And that has been because, as we see it, there are a number of mega trends that govern the transformation of the economy. First of all, there is a digital transformation of the economy. So that has an impact also on the business activity and as a result on the real estate markets. So as the economy transitions to a more digital form, the real estate investors will go more towards the properties used by the companies that are at the forefront of this digital transformation. That is the reason why you can see an increase in the demand of logistics space used by retailers who are selling their goods online. You see more logistics demand for data centers and less demand at the same time for the traditional store. Okay. Another mega trend is the energy transition. So we are moving from fossil fuels to renewable energy. And that has an impact also for real estate investors because even the wind farms, solar farms become an interesting and attractive investment for an investor looking for long-term income. Another mega trend is the sustainable development. So the cities have, urbanization has been here for centuries, but some cities like London, Shanghai, Mumbai, they've become too large. So there is a point where the urbanization reaches a peak and there is a demand for a more sustainable approach. So you can start seeing the growing of suburbs which offer a more amenable lifestyle. And then there is a general aging of the world population for a number of reasons. In some countries, some parts of the world, like the Western world, there is literally a decline in some countries of the population because the number of newborn it's lower than the number of people aging. There is, in other cases, it's just because the healthcare is improving, services improving, and therefore people live longer. And that creates a different demand for real estate. So there is a need for a senior housing. There is a greater need for healthcare facilities. And this is basically accompanied the investors, the real estate investors, is guiding the real estate investors towards new sector of the economy.
Given the uncertainty around the pandemic, the overall economic impact is yet to be seen. The pandemic has impacted the real estate sector significantly, with owners and managers concerned about maintaining value in their investments, with more stringent legislations requiring adherence to relevant COVID-19 protocols. Movement restrictions have led to the decline of the tourism sector, lowering investor interest in potential investments in resorts and related real estate. Construction has also slowed down in fear of real estate prices falling. Pre-pandemic resilience seen within the housing sector is being challenged, with the market now in a state of flux. Lockdown restrictions have transformed houses into now a space for living, working, and leisure, altering lifestyles, and this is undoubtedly expected to change the preferences for a desirable house in the future. Long-term impacts on the effects of COVID-19 on the housing market include tightened mortgage credit standards, a decline in new listing volume, and prolonged unemployment, of which the effects remain uncertain.
Real estate markets in general and the financial markets in general have been very resilient during the pandemic because of the enormous amount of government support. So that government support has filtered both to the consumers and to the businesses. And there has been a general positive reaction of the real estate markets. Of course, at the very beginning, there was panic. But within a month that the government started announcing various programs to support consumer and businesses, most of the real estate sectors and market recovered. The vast majority of tenants started paying the rents. Now, within this general view, of course, there have been areas of pain. And the two main sectors affected have been the retail sector and the hospitality sector. Now, when I talk about retail, obviously, I'm referring to the traditional retail. So the shops, like the clothing shops that were selling to the public, direct walking customers. These have been really affected. And when I refer to the hospitality, of course, Islamic investors have a narrow definition of the investable universe. They do not invest in all the hotels and a certain type of resorts. So they tend to invest in limited services hotels and family style type of destinations. Again, these were the sectors that suffered enormously because people couldn't move and they couldn't go on holiday. Okay. Now, conversely, there have been sectors that have been really thriving. First of all, the residential sector. People were at home and they continue to pay the rent on their rented homes. And secondly, as I was mentioning before, the logistics sector. The logistics sector really experienced a boom because demand for retailers who could not operate their traditional stores has been phenomenal because they have gone to warehouses to conduct their business online. And at the same time, you have the growth of the web traffic, data traffic, video conferencing, which requires data centers. So there has been, these sectors have been thriving. One sector that was very interesting was a traditional sector, but really did very well, was supermarkets. Again, supermarkets were essential, part of the essential infrastructure. So they didn't close during the pandemic and they started selling online. So they became an interesting combination of the new economy and the old economy.
Government-mandated lockdowns through much of 2020 and 2021 meant vacant home offices, office buildings, empty shopping malls and promenades, and closed restaurants. Impacts to residential and commercial real estate as well as mortgages are uncertain, given the number of commercial and residential property sales drops, abandoning of apartments in metropolitan areas, and households facing payment difficulties in redeeming their mortgages. Government rollouts of the COVID-19 vaccines are anticipated to bring some hope within the real estate sector, although markets are not expected to bounce back to normalcy right away.
Vaccination means moving forwards closer to the so-called herd immunity, which basically means freedom to move again, freedom to do business and freedom to consume, freedom to have leisure time and freedom to travel internationally. So the introduction, the discovery of the vaccines and the progressive vaccination of the population has meant that the strategy, which was called the stay-at-home strategy, so where you were essentially investing in residential, supermarkets, warehouses, and data centers, it's surpassed by the go-out strategy. So a strategy where people go back and look at the offices, go back and look at the hotels or lodging, and they also look at the leisure assets, like, for example, adventure parks, okay, zip lines. These are things that have been completely unreachable during this period. So the introduction and the rollout of the vaccines will create this interest in the sectors that have been left behind. But one thing that I would like to add is that the pandemic has fast-forwarded changes which were already in place prior to the pandemic. They just made life, the future, come 10 years earlier. Okay, so even if there is this return of interest to offices and hotels and traditional retail stores, it doesn't mean that the trends that were in place before the pandemic have just disappeared. Okay, so take offices. Everybody has learned how to work from home. It's been a big experiment. Even older generation have been forced to learn how to use a video conferencing facility. What does that mean for offices is that there has been a permanent, in my opinion, shift to less need of an office, which means that will translate over time in less demand for offices, and certainly different type of offices. Offices where you can collaborate, cooperate, a row of desk where you are just picking up the phone and typing on a computer, it's become outdated. Okay, so you do not really need to have to pay premium space in a central business district to have an army of employees just answering the phone and keying on a keyboard. They can do easily at home that, or they can do it in another cheaper location. So this type of trends have just been fast forwarded. So now we need to see what was going to be in the future. Going to the hotel sector, it has become difficult to travel. I mean, you travel, you want to stay 2 or 3 days, you are tested positive for COVID, you get stuck for 15 days, maybe 20 days before being able to come back. So when you travel now, you need to plan for a much longer stay. And you might well actually factor in the short term, but probably also on the long term, the fact that you might be stuck. I mean, it could be a health reason or for other reasons. So one thing that is emerging now is the merger between business and leisure. So this sort of changes are just going to move faster. So this is, I mean, it's not just the rollout of the vaccines. As the vaccines will be completely rolled out, you will see these changes taking place. People will not go anymore 5 days to the office. Maybe go 3 times. They will stay at home Friday and Monday. So 4 days at home, 3 days in the office, and they will travel less.
The International Monetary Fund predicts an overall recovery in the global economy with a 6% GDP growth rate in 2021 and 4.9% in 2022. However, it is expected that the pace of growth won't be similar across all countries, with developed economies recovering stronger than developing countries. The rebound of the recession will be led by increased consumer spending and higher savings boosted by stimulus packages. What does this mean for the real estate sector? Some say that the commercial real estate sector will see a boost driven by activity, with other investors expected to take a more cautious approach, awaiting more clarity before they sell, which could restrain the flow of marketable inventory, thus enlarging the gap between the buyers and sellers. By and large, however, issues and preferences related to the real estate sector are anticipated to remain similar globally.
This is a little bit of a futuristic some speculation, because we don't really know for sure what is going to happen to this, if the globalization will continue or will reverse. Okay, certainly there seems to be a big divide emerging between the East and the West. We read the constant tensions, geopolitical tension emerging between China and the US. And there are some lines that are being drawn in the sand. And especially for Muslim countries, which tend to span all the 3/4 of the time zones of the globe, it's a time of uncertainty. Which way do investors go? Do they continue to pour money in emerging markets, like China, the Far East, or do they go and look at the safety of developed markets, or they inward and just invest in their own countries? As an investor, I've been entrusted by my shareholders, the investors in my funds, to provide them safety of their capital and regular income. Okay, so I am not so expected to be an adventurous investor. I am expected to be a conservative investor. So I will look at the opportunities in Europe, in the UK, in the US, as opposed to venture in emerging markets. Obviously, that will depend on the appetite for risk for investors. So there are certainly opportunities to be found in towards the east, if you want, of the globe.
Thank you for watching. If you've enjoyed this video, please hit the subscribe button and click on the bell icon to get notifications on our new video. Do also follow IslamicMarkets.com on Telegram, LinkedIn, and Twitter. You'll find the links in the description below.